It's that time of the year again where investors are taking a look at their portfolio and how they've done in comparison to the S&P 500. And this is a constant struggle that active investors go through. Is it really worth the time and effort to try and outperform the index? So today we are going to go over a ton of information. We are going to take a look at the S&P 500, what companies make up that index. We're going to go over indexes that have actually outperformed the broader market, as well as some companies and what to look for if you're trying to pick individual stocks that gives you a better chance of outperforming. So if you enjoyed this video, make sure to drop a like down below. I really appreciate all the support on the channel. We are now about 60 subscribers away from 4,000. That is absolutely insane. Thank you guys so much for the support, and I appreciate you watching the video. If you do enjoy the content, subscribe down below. When people talk about outperforming the market, generally what they are talking about is outperforming the S&P 500. The S&P 500 is managed by S&P Global and is made up of the 500 largest US equities that cover around 80% of the available market capitalization. And according to S&P Global's website, as of December 27th, 2024, the index was trading at $5,970.84 with a year-to-date return of 25.18%. If you go to your brokerage account and you try and type in the S&P 500, you will not be taken to this index directly. You will often be taken to a couple of different ETFs, electronically traded funds, that actually track the index, the most common being SPY. We can see that SPY has delivered a return of 25.89% year to date. The other most common being VOO, or Vanguard's S&P 500 ETF. It has delivered a return of around 26.05% year to date. However, a 26% return from the market is not normal. According to Investopedia, ever since 1957, the average annual return of the S&P 500 has been 10.13%. If you consider inflation, that number drops down to around 6.37%. But keep in mind that this average is not normal. The market has been able to consistently provide single-year returns of over 15%. However, when you consider these large drawdowns that have occurred over time, that's how we get to this average of around 10%. What this ultimately leads to is you need to have a dual approach to the market. You need to be looking at the long term, the last 5 to 10 years, how have you performed versus the market, as well as over the last couple of years, how have you performed? In 2024, we saw a 26% return. What that means is you need to have put up a higher return than that to have outperformed the market. And that is consistent in 2023, where we also saw a 26%. In 2022, we actually saw a down year. That means outperformance of the market would be losing anything less than 18%. So if your account went down by 15%, you technically outperformed the market. One very common way of trying to outperform the index is by concentrating into some of the companies that make up the index itself and trying to pick the ones that are going to outperform over the next year. If we look at the ETF VOO, we can see its top 10 holdings. It's made up of Apple, Nvidia, Microsoft, Amazon, Facebook, Alphabet, Tesla, Berkshire Hathaway, Google again, and then Broadcom. However, when you look at the percentage that these make up of the overall fund, the highest is Apple, making up only 7% of the fund, with the 10th highest holding making up only 1.5% of the total fund. For example, let's say in 2023, you thought Apple and Nvidia had a lot of growth ahead of them in 2024. So you put 50% of your account in Apple and 50% of your account in Nvidia. If you look at these three stocks tracked together on one graph, you can see here in blue, we have Apple's performance. They are up around 32% year to date. However, the S&P 500 or VOO is up around 25.25% year to date, while Nvidia has returned 176.66% year to date. So if you owned just these two companies, Apple and Nvidia, you would have massively outperformed the market. However, keep in mind that the reverse is also true. If you had selected two very popular companies like Microsoft and Berkshire Hathaway, you would have underperformed the market this year because Microsoft has only returned 15% in 2024, while Berkshire Hathaway has slightly outperformed the market, returning 27 to 28%. So these two combined positions, if you weighted at 50% for each, would have actually underperformed the broader index. You can try and diversify away some of this risk, as well as still outperform the S&P 500 by focusing on ETFs such as this one here, which is MGK or Vanguard's Mega Cap Growth Index. It's provided a year-to-date return of 37.5% 2.5%. And this is not just a one-off performance. Over the last 10 years, MGK has provided an annual return of 16.3%, while VOO has provided an average annual return over the last 10 years of 13.3%. Keep in mind that past performance does not necessarily indicate future results, but we can look at this ETF and try and determine how they have been able to outperform the S&P 500. And for me, there are a couple of reasons why. The first is the one that we have already talked about. This fund is far more concentrated. They only have 71 holdings, and if we look at their top 10 holdings, we see a lot of similar companies to the S&P 500. However, their weighting is significantly more. Apple, for instance, makes up 13.21% of this ETF, with Nvidia coming in at 12.28% and Microsoft coming in at 12.12%. The second reason that MGK is able to outperform the S&P 500 has to do with the type of companies that it holds. For example, we're going to look at Adobe. Adobe makes up around 1% of this fund. Over the last 10 years or so, Adobe has provided a return of around 500%, while VOO over the last 10 years has gone up around 180%. And over that same time period, Adobe's top line revenue has gone from $4.1 billion to now sitting at $21.5 billion. And bottom line growth has also been strong over this time period. They were bringing in around 53 cents of EPS in 2014. However, today that number has increased to $12.40 of trailing 12-month EPS. And let's compare these numbers to a similar type of company in the S&P 500. For this example, we're going to select Oracle. Oracle makes up around 0.5% of VOO. And over the last 10 years, Oracle's also been able to outperform the S&P 500. It's up around 300%. At the end of 2014, Oracle was bringing in around $30.8 billion of revenue. That has since grown to $54.9 billion of trailing 12-month revenue. Revenue growth has been fairly solid. However, in terms of EPS, in 2014, they were bringing in $2.39 of EPS. That has only grown to $4.09 of EPS today. That means that Oracle over the last 10 years has grown their revenue by 3.5% yearly and their EPS numbers by around 5.5% yearly. However, Adobe is a vastly different story. They have been able to grow their revenue by almost 18% yearly and 37% for the bottom line. And these are two very clear examples of what MGK is looking at versus what VOO is looking at. MGK is focused on top and bottom line growth. They are a growth ETF, and that should be important for you as an investor. It makes a lot of sense when you just think about it, but companies that grow their top and bottom lines are going to see stronger stock price appreciation. However, this is not everything. There is one final thing that is important when you're selecting stocks to try and outperform the market. And for this, we're going to jump back and we're going to look at Apple versus Berkshire Hathaway. In 2014, Apple was bringing in a trailing 12-month revenue of $199.8 billion. That has since increased to $391 billion. And Apple's bottom line numbers have also seen solid growth. At the end of 2014, they had a trailing 12-month EPS of $1.87. That has since grown to $6.08. On a revenue basis, Berkshire Hathaway actually looks very similar to Apple. At the end of 2014, they brought in $194.7 billion of trailing 12-month revenue. Year to date, that number has increased to $369.9 billion. Berkshire Hathaway's EPS numbers look a little bit less consistent than Apple's. However, at the end of 2014, they were bringing in $8.06 of trailing 12-month EPS. That has since increased to $49.50. And this is how these two companies compare. When we look at top-line growth, Apple has been able to grow their top line by 7.12% annually over the last 10 years, with Berkshire Hathaway growing their revenue by 6.8%. On the bottom line, it's actually flipped, with Apple able to grow their EPS numbers by 12.85% and Berkshire Hathaway outperforming Apple, growing their EPS numbers by 20.45%. So when you look at these numbers, you basically see matches in terms of top line growth, with Berkshire Hathaway outperforming on the bottom line. So what you would expect, at least just from looking at these numbers, is that Berkshire Hathaway has been the outperforming stock over the last 10 years. But this is not necessarily the case. From 2014 till now, Berkshire Hathaway stock has gone up 211%, while Apple's stock stock price from 2014 till now has returned over 800%. And what's causing this key discrepancy between these two stock performances over the last decade is what investors are willing to pay for these two companies. In terms of Berkshire Hathaway, in 2014, investors were willing to pay $18.64 for every dollar of earnings that the company brought in. However, today that number has dropped to $9.22. So over the last decade, Berkshire Hathaway has seen their valuation compress by about half. However, Apple has seen just the opposite. In 2014, investors were willing to pay $13.21 for every dollar of earnings that Apple brought in. However, today that number has expanded to $42.04. And that brings us to the final factor that you really need to consider when trying to outperform the market, and that is valuation. Right now, the S&P 500 is trading at a valuation of around 27.52. We have seen it drop below 20 as recent as 2022 and 2018. Both of these were great buying opportunities. So you really need to consider the price that you're paying for the company along with the growth that you are getting for that company. To summarize everything that we've gone over, you want to pay very close attention to companies that have strong top and bottom line growth numbers. If their revenue is growing by 7 to 10% and EPS growth of 10 to 20%, that is going to be a strong company. But when you find those companies, you want to make sure you're not overpaying for them. The S&P 500 right now is trading relatively rich. If you can find these companies that are growing at very high rates at low valuations, let's say somewhere below a 20 PE ratio, ideally a 15 PE ratio is even better, then those are going to be good companies that offer growth in terms of top and bottom line, but also potential growth in terms of their valuation expanding over time. And then once you find those companies, concentrate into them. Make sure you are weighting your portfolio very heavily into these very high quality, high growth companies. If you have trouble finding companies like this, make sure to subscribe. I talk about a lot of different stocks on this channel, and you can try and look at those companies and see if they are right for you. As I always say, don't buy a company just because I talked about it on YouTube. Make sure you are doing your own research and looking into companies that meet your risk tolerance as well as your time horizon. If you enjoyed this type of video, make sure to drop a like down below and subscribe for more videos like this one. And as always, guys, have a wonderful rest of your day. And for the joke of the day, what do you call a ghost in the winter? Check the comments down below for the answer. Thanks for watching.